Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for January 16th, 2026. We're recording at 12:30 p.m. Eastern Standard Time. So here's your starting lineup. Number 1, Fed independence. Markets don't seem to be too concerned. We remain sanguine about this subject. Number 2, credit markets. Tight as a snare drum. And number 3, thoughts on the possibility of Iranian regime change. So number 1, the DOJ criminal case appears to be overtly political rather than substantive, and I think that's part of the reason the market's response has been very muted. Not a big rise in volatility early this week as a result. Chair Powell pushed back forcefully in his video last Sunday evening. I think that's positive action from him and not so passive, which has kind of worked, but not entirely. Nice to see business leaders like Jamie Dimon and others pushing back on the potential corruption of Fed independence, and global central bankers also pushing back. Even some Republicans like Tom Tillis and Lisa Murkowski have vocally pushed back on this DOJ subpoena and criminal case against the chair. It's nice to see that the world really cares about Fed independence. It's so important to investors, and this is a really good thing. So the DOJ action will make life more challenging for Powell's replacement. It's just going to be hard to come in with very much credibility, almost no matter who you are, because the president has said that he will only nominate someone who will do his bidding. And we think it'll now be harder for the proposed chair to be confirmed. And delays are certainly possible. Tillis has said clearly he will not vote for any new chair until the DOJ case has been resolved. The Lisa Cook case is in front of the Supreme Court, and I think this case takes on greater urgency and importance as the rhetoric and the heat has been turned up on the Fed. The DOJ action increases the odds that Powell actually stays on after he steps down as chairman. Remember, he has 3 more years on his full term, which doesn't expire until the end of January 2028. So a president cannot dictate policy via a new Fed chair. Each board member has an equal vote. The chairman does not have a super vote and cannot just cut rates by fiat. So I think the Fed is probably not going to make its next cut until the spring or even early summer. Economy is doing very well, and the cut will be based on the evolution of the labor market, the path for inflation, and the aggregate data. Now on to number 2, credit markets. Global credit markets are running at the highest RPM in decades. We're almost certainly going to get record issuance this January. Some measures of credit spreads like triple C's to double B's are the tightest in at least 15 years. Most of the spreads that we monitor have reversed from the widening that we saw last fall during the credit panic. And the Bloomberg Global Corporate Credit Index is the tightest since 2007. So spreads are tight because the U.S. economy is booming. The Atlanta Fed GDP now is running 5.3% for the first quarter of 2026. That's the kind of growth we used to see back in the 1980s. So this is really strong, appears to be very strong start to 2026. And spreads are tight due to the Fed rate cuts, rising liquidity, outright complacency by investors, lack of fear, and good old-fashioned yield burn. We know that demographics in this country continue to age, and there is an insatiable demand for yield. And some investors are simply willing to take on more risk for another 100 basis points, which we don't agree with. We wouldn't do it, but we think that's part of what's going on. This week, we had bank earnings from quite a few banks, and banks on balance reported and told us that credit quality stayed resilient, with charge-offs being very contained. Bank loan loss provisions were generally flat or declining versus the prior year, and 60% of banks that reported this week booked less in the way of loan loss provisions than analysts were estimating. So credit fundamentals are strong, they're healthy, spreads are tight, but there's not much room for error. And I would maintain that you're not really getting paid enough to take this risk, and you may be better off just taking on equity risk than credit risk at this point. So we continue to favor private credit for higher yields, tighter documents, stronger covenants, lower LTVs, and just generally greater opportunity. So now finally, number 3 in our thoughts on the potential for Iranian regime change and what might happen in markets if that takes place. The betting markets are placing the odds of the Iranian supreme leader being out by July 1st at 40%. So we thought, okay, if it's that high, we've got to think about what could happen as a result. We would put the odds of regime change probably only at around 20%. We've watched this regime since 1979. They have been incredibly resilient. There are several times in the past when the regime probably shouldn't have made it, but they always did. And so we are not in agreement with that 40% by July 1st. But just thinking it through, Iran, we know, is close to maximum capacity for oil production at around 3 million barrels a day. We know the U.S. does not want to upset that production. That's a very important production on the world markets. And the oversupply situation simply remains for crude oil. We don't think OPEC's going to be dialing back. We don't think U.S. shale is going to be dialing back. We don't think Iran's going to be dialing back. And we hear that Delcy Rodriguez is playing ball with the administration, which increases the odds of greater production at the margin. There are some easy fixes we hear that can take Venezuelan production from a very minimal 800,000 barrels to something modestly higher. That's more production. So I think the play here is not to be short crude oil anymore. That was the best idea for the last 2 years. In fact, crude oil was the worst performing asset in all of 2025, down almost 20% on the year. There's a heavy short base. There are only 5% bulls, some of the lowest sentiment readings we've ever seen. And we're noticing that the political risk premium continues to rise for crude oil. So we would not be short. We would sit back and wait for the event. If it happens, we don't think it's going to happen, but if it does, then you get an opportunity to sell oil much higher, probably, $6, $8, $10 a barrel higher, and that would be a good opportunity to sell. We've watched a lot of these geopolitical events affect the oil market over our career, and it has almost always been an opportunity to sell, and we think this time would be no different. Now, thinking about equities, of course, the likelihood is that equities will suffer in the very near term, but we think the opportunity would be to buy emerging market equities. We think they'll eventually rally on the news of a new regime in Iran, and they are likely to be the ones hit the hardest if that event takes place. U.S. fixed income could rally. Of course it'll rally on the event, but we think it could sustain a rally if oil prices come down even more and finally break $50 a barrel, and we think that's a very strong possibility in 2026. Gold and silver will probably rally very sharply and then fade. That would probably be an opportunity to reduce exposure, especially to something like silver, which is on just an absolute parabolic rise. And who knows where it could go after this blow off to the upside. So the bottom line for us is a new Iranian regime would likely be positive for global growth, lower inflation, and be bullish for risk assets. But it will take some fortitude in the near term to get through it. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.